Good afternoon, everyone who's joining us here today, and good afternoon or morning or evening to anyone who is watching the recording after the fact. We are pleased to welcome you to this webinar that Krutham is hosting, an interview with Manfred Schippers, who's the CEO and founder of ILX Fund Managers. The run of proceedings will be that my colleague Stuart Theobald will do an introduction, and then we'll go into conversation with Manfred, and we will throughout be open to questions and commentary from those of you on the attending today. You're welcome to throw those into the chat or the Q&A, and we'll answer as many as we can. Over to you, Stuart.
Thanks very much, Nicole. Good afternoon or good morning, depending on where in the world you might be watching. Very good to have you with us, and very good to have Manfred and ILX Fund here to discuss their approach. Just a bit of introduction on Krutham for those who are not familiar with us. We're a consulting firm who focus on developing financial sector outcomes that are in line with public policy objectives, and we really intermediate between the public sector and the financial sector in ensuring that both sides are able to work towards delivering value to the societies in which they operate. And of course, within that context, a lot of our focus is on how our investors apply their capital towards certain objectives that go beyond just returns. And I think in the case of ILX, we have a world-leading example of an investor who has thought and developed those approaches. And it's here particularly because the UN's PRI, the Principles for Responsible Investing, recognized ILX as a leading award winner, winning for responsible investing policy, but also winning as Emerging Markets Investor of the Year. So there's a great deal we can learn, and I'm looking forward to the engagement. Nicole, my colleague, will lead that engagement. Nicole couldn't be better suited as a previous head of UNPRI for Africa and a judge in this year's awards. So looking forward to it. Over to you, Nicole. Thank you.
Great. Thanks, Stuart. Yeah, and it was a really hotly contested category. I will say that I mean, most of the PRI signatories from around the world, the first thing they do is develop their responsible investment policy, right? And so it's very difficult so many years on from the creation of the PRI and to come up with something that's considered to be innovative and new and different. And so really a heartfelt congratulations to ILX for that. Manfred, I think maybe a good place to start is with a bit of an introduction from your side into ILX Fund, who you guys are, and what it is that you do.
Good. Well, thank you, Stuart and Nicole, for asking me to join the webinar. It's a real pleasure, particularly as I grew up as a child in the background of Nicole in Cape Town. So it's a pleasure. Now, thank you for your kind words, and of course, for us, it's been a huge honor to be awarded these, be recognized by UNPRI, which it's always nice to know that when you set out on a journey in creating ILX, you never know where it will lead, and we're still in the middle of the journey. But I think to get a recognition that we're doing the right thing by an incredibly esteemed group of judges, of course, is a huge compliment to the team and to the investors that are supporting us, and to our partners who are providing us with the assets. So it's a big ecosystem, and what I thought would be useful is to share a bit that story for you. So let me just put that up. So bear with me a second to get the technology working. And I think this is kind of working. Okay. Oops. Yeah, I think this is it. Yeah, you can all see it. Yeah.
Yes, we can.
Yeah, so effectively what ILX is we are a development finance fund. I think we started off now in January 2022 as a SDG and climate-focused emerging market private debt fund. even over these past years, I think the concept of a development finance fund is being seen as being okay to talk about development finance. Development finance was seen as something that governments do, is not something that institutional investors do. And I think increasingly we can talk about development finance and don't have to give it complex labels like emerging market private debt fund, which of course that's what it is. Our journey started a little bit my own background. I was the Vice President and CFO at the European Bank for Reconstruction and Development, which supports the countries of Eastern Europe, Central Asia, after the Arab Spring, also in the Mediterranean region, and as of the coming years now also in Sub-Saharan Africa. But I was there for 10 years, very interesting 10 years, 2006 to 2016. Of course, financial crisis, Eurozone crisis, invasion of Crimea, the Arab Spring, the transformations that have been seen in the Middle East, but also the Sustainable Development Goals and the Paris Accord in 2015. And all of that, what I observed during those years in the EBRD, which is a private sector focused development bank, I learned I kind of learned to love development finance, because on the one hand, it used the financing technologies of private finance, call it that, but doing it under the auspices of public finance, guided by its shareholders. Recipient countries are very much engaged in the way development finance is done, in the way that in Africa, with the African Development Bank and the IFC are very much engaged with the World Bank Group. The same applies to all the multilateral development banks. And as the EBRD, I was CFO. I played a coordinating role among the CFOs of the various MDBs. And we learned a lot about, or I learned a lot about, what are the risks and returns of development finance. And of course, I knew that the risk and returns were good, the risks were well managed, and the returns were attractive. And on top of that, they were completely aligned with what the Paris Accord was aiming for, and they were aligned also with the SDGs. So we started with the what was also observed, and particularly after the financial crisis, is that the regular capital flows, especially international banking, so the capital flows from Europe, North America into emerging markets had all but dried up. You had some that were still active, Standard Chartered, HSBC to some extent, but overall we saw just a dramatic withdrawal of international banking from the emerging markets. And at the same time, the capital markets remained very underdeveloped. Of course, you had some large markets, China first most, and India and Brazil. And South Africa, of course, because of its historic development and the fact that you had a pension insurance sector. But most markets, the capital market remained very underdeveloped. And because the international banks withdrew, a lot of the linkages and market development also stopped. If you're, from my side, before my time at EBRD, we worked on market development because the international banks were active in Africa and Asia, Latin America. But as they withdrew, a lot of the financial market development also came to a halt. And so it's been clear that since the way to address the SDGs and the climate agreement across emerging markets was very much, in my view, going to be on the shoulders of, in particularly, the multilateral development banks, but also the regional and national development banks. In 2018-19, that was not so overtly spoken. Of course, if you now read what has come out of Baku, which one can criticize it for its total amount of commitment, but it's very clear that the role of the multilateral development banks in addressing the climate agreement alongside the SDGs is going to be central. So we got funding in 2018 from the Dutch, German, and UK government to explore the unlocking of development finance, which required data. And the data was not easily available. So we worked with the MDBs, the GEMS data set that some of you might be familiar with, which is an aggregate data reporting of all the multilateral and the national development banks. That data we were able to work with, and that gave sufficient confidence that the asset class can stand on its own two legs, that participating in a diversified pool of loans from the multilateral development banks and the large national development banks is actually generating a return that can stand on its own two legs as part of a larger pension fund. And we worked with the Dutch pension system, which is quite unique in its structure. It's quite concentrated. It's got a few very large pension funds. Our largest investor that has now committed $1 billion to ILX is ABP. It manages a total fund of 550 billion. The Netherlands as a country has $2 trillion of pension assets. And if you include Scandinavia and the UK, you're looking at $10 trillion of pension assets. So there's plenty of pension assets in terms of being able to scale up development finance. But we are at the beginning, really. I think of that 10 trillion, ILX has now got 1.7 billion of commitments. And I think the total commitment of those pension funds towards development finance as a risk asset class is 1.7 billion. I think we're still at the very, very, very early days. And this is part of the whole conduit. Can these pension savings be a significant part of this scaling up of development finance that needs to happen over the coming decade? And our belief is that it clearly can. If you look at what we do, we effectively, we invest in loan participations of the development banks. So we are not sitting in Amsterdam, taking the plane to Nairobi and Dakar and Joburg every week. We effectively work with the IFC, the EBRD, the Asian Development Bank, African Development Bank, IDB Invest, and then also the national development banks. And we participate in their loans pari passu. So we share through a loan contract the loans that they make, and we disperse when they disperse, and we get interest and principal when they get interest and principal. And if there's a problem, we share the problem with them. But we did it in a diversified manner, so we have got a portfolio across the MDBs, across regions, across sectors, and that generates a risk return that is attractive for our pension fund investors. And at the same time, we get all the safeguarding, all the SDG and climate targeting and reporting of the development banks. And because of that, we're under European regulation and SFDR and sustainable finance disclosure requirement, Article 9, which is a dark green fund, because we can follow the money. When we disperse, when there is a project, and we get project level reporting. So we don't go into a black box of buying a green bond or a sustainable equity fund. No, we buy project by project, and so we can follow the money. There's a theory of change on every investment we make, and we get reporting of the change that we seek. That's why it's super attractive for these pension funds to do so. From a counterparty standpoint, it's a bit technical, but obviously all of them are AAA rated. So we have our counterparty risk with the development banks is AAA, but we take the full project risk pari passu that they invest in. And it's very scalable because, as the Climate Accord identified, the MDB finance, which announced in Baku that they will scale up their climate finance to 120 billion a year, plus around 125 billion a year, plus around 60 billion of mobilized finance a year. That's part of the 300 billion that was announced on an annual commitment at the Climate Accord. So, it's this universe, that box of global MDBs, is going to be central over the coming decade in terms of providing finance to the emerging markets. So from a supply of assets standpoint, we've got to expect that the supply is going to be sufficient. And the question is, the pension industry, and if I said in Europe alone, or not in UK, Netherlands, and Scandinavia alone, there's 10 trillion of pension assets if you add North America, Canada, US, and countries like Japan, Korea, Australia, New Zealand. Europe, and you look at the sovereign wealth funds in the Middle East, there is probably close to 100 trillion of long-term savings. You're able to take this risk. This risk is sub-investment grade. This risk is emerging markets. But the global pension funds globally are able to take emerging market risk. So it's not that it's different to the retail investors in Europe or insurance companies who need investment grade. Pension funds and sovereign wealth funds can take emerging market sub-investment grade risk. So the supply of capital and the supply of projects seems to be abundant. It's a matter of now just building confidence in scaling it up. Performance-wise, this is just a brief summary where the historical data, and the historical data shows an incredibly convenient truth that development finance has outperformed the indices that these pension funds have got literally trillions invested in. High yield bond markets, emerging market bond markets, and leverage loans. Where there's high volatility because they are very crisis sensitive. Of course, it's a little bit apples and oranges because development finance is private credit and therefore it's marked to model. But if your credit losses are low and stable over time, if your credit margins are stable over time, guess what? Your valuation is stable over time. The pension funds are able to invest in private credit, and therefore the total return of this asset class has outperformed the other assets with far lower valuation volatility. So it's incredibly attractive, and all the ESG safeguarding and climate and SDG impact comes on top of that and comes for free, because this is what the development banks share with us. They share us all that data. And of course, the whole fee structure also is very, very different and much lower than the other asset classes. So there's no reason why this can't be scaled up from a cost standpoint and a supply standpoint and the capital standpoint. It's a matter of just telling the story. So we do it across sectors, so energy and energy access, infra and sustainable industry, finance, and food security. I'm going to Q&A. We do it globally. So this is us after 2 years. And of course, we're adding new countries as we go along. Africa is still relatively light for us, although we've signed 2 new very interesting agri projects over the past week. So there it's growing, but Africa is a country where you know better than I. It's project preparation, project executions is more difficult than regions like Asia or Latin America. But the potential, of course, is enormous, and so we're very optimistic. That's a brief introduction. I'll stop there.
Thank you, Manfred. That's excellent. It's really helpful to get that overview and to understand better how the model works. And also really exciting to see how in such a comparatively short time, we've managed to achieve so much and grow so far. And I think it's particularly interesting the fact that over this time, you're able to show those results around the impact and the financial materiality, right? So that you're achieving that impact not at the cost of financial return. I do think that that's one of the bigger concerns that investors will have in emerging markets generally, but when it comes to ESG integration in particular, there's a sort of misperception that you are sacrificing return if you're taking into account these sort of non-financial metrics. So that's really interesting to see. Also really interesting to see the appetite from the pension funds. I do think in certain markets, and I know particularly in South Africa, there is a bit of a hesitance from pension funds to violate fiduciary duty by straying too far from the benchmark and from the norm. Though increasingly there is an impact mandate that's starting to grow. And so pension funds are starting to explore impact investment a little bit more, but it's usually quite a small portion of their book that they're sort of dedicating to that. So it's really interesting to see all of that. I have to ask about the Africa map, right? And why you sort of touched on the fact that you're a little bit light in Africa and that it was maybe a bit more difficult to do deal structuring on the continent. I mean, one of the things that is definitely being picked up a lot in Africa, particularly is this idea that emerging markets are associated with a higher risk perception and tend to get bounced out of the investor contention when you start integrating ESG. And this is sometimes just because of a lack of data. And sometimes it's because of poor performance on ESG metrics, but that's sort of exactly why those markets need this investment, right? To sort of progress and move forward. Can you tell us a little bit more about that kind of risk assessment when it comes to emerging markets in general and Africa in particular?
Yeah. I think the risk perception, we are, we're following the historical risk performance of development finance, which is embedded in the GEMS emerging market database. You can literally, it's publicly available as of a month ago at the World Bank annual meeting. It was made public. So if you go to GEMS, I don't know what the website precisely is, but if you go to GEMS emerging market and you Google it, you'll maybe I think Nicole, you can post it on the chat. But I think it's there, and it has time series over time in terms of PDs, migration, recovery rates by sector, by country of MDBs in aggregate. It doesn't split out by MDB. That's of course confidential, but it does look at country and sector globally over the past 30 years. So it tells a story, more than 10,000 obligors, and Africa stands out not as a particularly risky place to do business. So the problem for us also in Africa is very much just the pipeline. And I think that's, I think the reason for that is that it's if you look at the energy networks, if you look at the trading networks, if you look at the banking sectors, there's still a significant fragmentation. Of course, there's also still from our side, we effectively invest down to B-, and so therefore there's still a significant group of countries in Africa that are CCC. We can't invest in them. But that's not also where the big pipelines are. I think our issues, we have plenty of capacity to invest in South Africa, in Kenya, Tanzania. So there are many countries in which we can do it, and we are increasingly doing business. So it is beginning to happen. We just signed literally over the past weeks two agribusiness, one with ETG. It's a Pan-African agriculture and commodities company, and a company Robust. We've invested in Terrapay, which is a Pan-Africa fintech, specific remittances. We've invested in banks in Egypt and in Nigeria. So it's going to come. I have no confidence. Our story is not an ILX story. Our story is the IFC story, the African Development Bank story. And so I think everybody recognizes that the pipeline of projects across energy transition, across manufacturing, are just more difficult than they have been in Southeast Asia or Latin America. But I'm confident that there's so much focus on it now that those pipelines will grow. If you looked at the amount of renewable energy installation, of course, it's been greater in Southeast Asia. It's been greater in countries like Turkey and Central Asia, but it will come. We're also looking to work with other African partners in Africa, more the region there, the Pan-African development institutions that also exist. So it's not a risk issue. It's really just a pipeline of good bankable projects, just because of the size and to some extent the fragmentation of Africa. That's made it more difficult. Yeah. The other aspect is local currency. We are currently only investing in dollar and euro loans, just because I think what ILX has done, and I think you recognize that, Nicole, in the PRI awards. I mean, of course, it's phenomenal that you're getting Europe's largest and most conservative investor effectively, on the face of it, doing the most risky thing. I mean, they have done something which is more adventurous than any other pension fund in the world, and they're Europe's largest pension fund, historically the most conservative. So they've walked an incredibly important bridge. So everybody's now looking at it. Whoa, why are they walking over that bridge? Why don't we? So this is precisely what we want to achieve. But this is something which, of course, it's also at the same time dipping its toes, and therefore, what we now are investing in is effectively the not excessive risk premium, but the attractive risk premium that development finance offers. So they're very smart, and they've made a very smart move, first mover, and they're recognizing that the return on risk accompanied by such strong impact and such very good safeguarding is a very attractive investment. But from a currency standpoint, of course, they have a significant dollar allocation, significant euro allocation. They do invest in local currency, but managing diversified local currency is very complex. We are effectively now managing diversified credit risk. Yeah? Diversified globally, diversified by sector, diversified by MDB. So let's get that right. We're now scaling up. Everybody recognizes the data is very robust. Local currency, I think, is going to happen, but obviously creating diversified local currency is more complex. It will be easy, of course, in a country like South Africa. It will be easy in a country like Brazil. But doing local currency across Africa is more difficult, just because the domestic markets, of course, are very, very different. You cannot compare the South African rand market with the Kenyan shilling market, even for that matter. So the local currency dimension is one that I personally recognize is something critical, because obviously at the end of the day, each country needs to invest in its own infrastructure in local currency. It cannot be foreign currency funded. But I think as a first step, the dollar asset is the one that is enabling these large pension funds to start getting engaged in continents like Africa. Long answer to an easy question.
No, I mean, that's very exciting for African impact investees and sort of those involved in the project preparation. And I guess it also speaks to the role of policy and regulation in creating that enabling environment so that we can build that pipeline. And I do think you're right that is getting better over time. So we're seeing that progress. We're seeing, like you mentioned in Baku, we've seen some commitments to South Africa. Of course, the vast majority of them are concessional loans, which people will have differing views about. But one of the things I would definitely like to ask you is that we definitely acknowledge that it is a unique, innovative model, right, that ILX Fund has in place. And like you say, it's a first of its kind, brand new thing for some of these investors to do. What's that conversation like? How do you, before you've got track record, before you've got sort of your proof of concept going, how do you have that conversation, and how has that conversation evolved with investors over time?
Well, I think we started off, of course, with it's all about giving people comfort that the risks are being properly managed. I think, if you talk about people about equity markets, if you say, well, these new equities are listed on NASDAQ or the New York Stock Exchange or the London Stock Exchange, say, oh, that's fine then, so I can invest in them. So tell me about how racy they are, and it's only about the return, tech stocks or anything. And here it's a bit the opposite. Here is like, oh, okay, I've never been to. I've never invested in Nigeria before. I've never invested in Kenya before. What does it look like? There's no concept. So I think from our side, what we kind of chose is the multilateral development bank system to be our New York Stock Exchange. It's like, no, we're not. Don't worry. It's not just a couple of people from Amsterdam getting on a plane to Nairobi or Dakar. No. It's a highly reputable group of people in Amsterdam, and the only thing they do is they occasionally might visit the African Development Bank in Abidjan, or they might visit the EBRD in London or the IFC in Washington, and will work with these incredibly reputable institutions where the Dutch government is also a shareholder, has a local representative to make sure that nothing unbehest is being done. Okay, well, fine. Now that sounds like a good safety. And they know And the other part is they know these institutions already, because there's large pension funds in Europe and our investors currently. Of course, they've known the World Bank and the IFC for the past 50 years. They've been buying their AAA bonds all the time. So the supranational borrower world is very well known by these large investors. But until now, it was just the AAA bond. The only thing we're offering that is different, we're saying, well, don't buy the bond, buy the asset. It's much smarter. You know where the money is going, and you're going to get a much better return on risk. And so it's basically saying, well, stop buying the AAA bond, just invest in the asset directly. So I think that's given them the comfort that, okay, it's safe to go there. It's we go hand in hand with the IFC or hand in hand with the African Development Bank. We don't, we're not just going on a wild goose chase somewhere in West Africa. It's got this incredible safeguard, and that's why I draw the analogy with. Why do you create stock exchanges? Well, because there is listing requirements and everything else. Well, we have the same thing. If you go to an IFC or you go to an EBRD, to get a project done, by the IFC and EBRD in terms of the environmental and social and anti-corruption testing and filters and safeguarding, well, you end up with a pretty good project.
Yeah, and I think obviously if you've got that, like you say, that credibility around the risk management angle, I think that's really interesting, because obviously if we go back a good 15 years now, I mean, the conversation around ESG integration, it wasn't at impact level yet. It was all about risk mitigation. And I think at the core of it, that still is the jump off point for most of the conversation is, am I mitigating risk? And I think, to be able to give that comfort also gives investors, particularly pension funds, the comfort to know that this isn't a violation of my fiduciary duty. It's fully aligned to the responsibility I have. And there's this added bonus of having some sort of systemic impact, which in and of itself is, of course, good for my investments as well.
Yeah, and I think we are only going to be able to make the world a better place to live in over the next decade by working with these pension systems. Why? Is because they have the size of capacity to finance the size of the investment that is needed. Yeah? Now, working with them is very different to the philanthropists. Why? Because the philanthropists are absolutely not going to put all their eggs in the climate transition basket of Africa. They'll put some of their excess savings that they don't mind losing. Well, that's not how pension funds work. If you want to work with a pension fund, you're at the core. They don't have these pockets of chuck away money. That doesn't exist in a pension fund. But if you're in the core of the portfolio, they are enormous. And if we want to, put the planet in a better place, we need to work with the core of these portfolios. It's so we can have lots of nice meetings with philanthropists all over the world, but you're dealing with ultimately with the crumbs, because they're not going to put the core of their portfolio in doing this. That's their wealth comes from founding Amazon or Microsoft or things like that. That's their business. And so I think, it's a bit of a controversial remark, because a lot of people, of course, a lot of philanthropists are very generous and they do a lot of good things, but it's not the core of their business. And I think this is something in the same way as for the commercial banks. I love the Dutch banks, but I know for sure that making energy transition investments in Africa is over the coming decade not going to be at the core of the business. It's just not going to happen. So don't waste your time having conversations with them about the energy transition in Africa, because there's nothing they can do about it.
Yeah, I definitely think that's something that would be great to see more African pension funds getting involved in. I mean, the largest pension fund on the continent is here in South Africa, the GEPF, and I know that the conversations over the last few years that people are having with the trustees and the members has really evolved, and people are starting to ask more than just, am I going to retire well? They're asking, what kind of world am I retiring into, and what are you doing with my money to contribute to that? And so it would be fantastic to see more involvement from sort of our local pension funds in this kind of model. In the meantime, we have a question that's coming from the audience that I wanted to read to you, so you could have a stab at it, we picked up some concern in African markets that the MDBs can distort domestic financial systems by bringing in lower price capital that can result in domestic financial repression. Is that a legitimate concern in your view?
I think it depends a bit on the first of all on the currency issue. That I can see, because I think the MDBs in particular, of course, are AAA rated, so their ability to refinance is far more competitive than commercial banks. If the IFC would raise money, long-term money in South African rand, they can probably raise it cheaper than if a commercial bank raises long-term money. The commercial banks have access to deposits, but obviously, if a commercial bank is always trying to make a renewable energy loan for 10 or 15 years, they also need to refinance it for 10 to 15 years. It can be that the refinancing capacity of a AAA entity is lower than of a domestic commercial bank. And that's where sometimes we see criticism, because the commercial banks, in Africa, of course, also like to participate in renewable energy investments. And there, it can be difficult just because the refinancing costs are more complex for some players than they are for the MDBs who have AAA access. So I do see that. And of course that issue is less prevalent in local currency, I feel, than in hard currency. Because of course, if you talk about dollar refinancing, there the competitive advantage, of course, is fast. The ability for an MDB to refinance dollars is far better than any bank that is not inside the United States of America. That's very prevalent in Africa. So you do get this issue that there are competitive advantages. But I think what's important is to compare apples with apples. You cannot refinance an infrastructure project or a renewable energy project with a 5-year loan. You can't do it. It doesn't repay in 5 years. It needs repayment periods of, to make it affordable. Renewable energy needs 15 to sometimes 20-year repayment, because that's how long the wind farm lasts. Or if you take things like hydropower, it's even longer. So to make things affordable, repayment period needs to be long. Everybody talks about the affordability of renewable energy. Of course, well, if you want to cram the repayment into 5 years, it's going to be ridiculously expensive. So there is that tension between short-term finance of long-term projects, which is difficult for many projects, and but domestic banks still like doing that, or domestic investors, versus the availability of long-term finance. So it's an additionality question. So there's a lot of technicalities around it, but I do take the point that it's something that the MDBs really need to guard themselves. It's also, I have the discussions also with the MDBs where the scaling up of ILX, it's a very important point. The scaling up of ILX should enable the MDBs to take more risk where an ILX investor cannot participate. So in countries where ILX can participate, take South Africa, take Kenya, take Egypt, Senegal, maximize the mobilization with parties like ILX. And when it then comes to countries that are more challenging, whether or not it's Mozambique or Malawi or Rwanda or Uganda, take more risk directly as the multilateral development bank, because it's more difficult to have an ILX participate. So for them to take the more risky projects and then allow the private sector to share more, because the role of the multilateral development banks in countries like South Africa and Kenya and Senegal and Egypt is still significant. So it's not that they are not important, but they can mobilize parties like ILX easier than they can in triple C rated countries.
Yeah, and I think, that's a good point, right? It's about that idea of using this kind of investment to crowd in additional funding, right? And I think, as far as the sort of national development agendas would go, it would be fantastic if you could crowd in domestic funding for those same purposes. Is that something that you see often?
I think that's very much a take it a Kenya, South Africa situation. or South African.
Okay.
Yeah, that obviously, for example, for us, for us, it's quite challenging to find projects in South Africa. Why? Because, of course, South Africa has a relatively deep South African rand market. And of course, it's preferred that long-term projects in South Africa are financed in South African rand rather than in foreign currency. So I think the issues around the MDBs, I think financing in South Africa, as it will be South African rand, should work with domestic long-term savings partners, pension funds in South Africa at financing those projects. That's currently not where ILX is operating, because we're only operating in dollars and euros. But I do see definitely a role for the pension funds in countries such as South Africa and Kenya, and there are certainly in Nigeria, for them to work with the development banks in doing local currency long-term projects. There's definitely a role in that.
No, that's fantastic. We've got some more comments coming in. Let me just catch them for you. We've got some on sort of the practicalities around how you operate, so we'll get to those. And then we've got one that's coming in. Someone has sent through a message to congratulate you on closing your second fund with the Danish pension funds joining for the first time. I think the role of the pension funds is definitely something that we've identified as very important. One of the questions is, what are the issues for European funds that would enable them to participate?
Well, in reality, the issue we see with investors other than, there needs to be an ability for a investor to invest in private credit, which we should not take for granted. Even in the Netherlands, the large pension funds that are participating in ILX, they have got a reasonable experience in investing in private credit. But private credit for many is still new. I mean, we went through it ourselves in creating ILX. Finding the right administrator is not so simple. Finding an administrator or a custodian for a portfolio of bonds or a portfolio of equity, plenty. Finding an administrator and a depository for private credit is not something that is so easy for all investors. So it needs to be, and then you cannot, and investing in ILX without having the ability to properly administer and value and manage that in your portfolio, of course, is not correct. But it's changing rapidly. I mean, I think the whole institutional investor community is clearly now realizing that investing in private credit is just and it's also not an asset class that's uniform. What we do is very different to, Dutch mortgages, is very different to direct lending in the US mid-cap. So people talk about private credit as if it's some kind of, bond market equivalent. No, there's a huge variation in the instruments that are part of private credit. In the same way as private equity. I mean, you've got all kinds of different strategies in private equity. It's not just a single asset class that you can put into one individual bucket. You've got infrastructure equity, you've got renewable energy equity, private equity, and you've got buyout private equity. So also private credit. So private credit is one that I see as a big hurdle. For some investors, liquidity, but that, with pension funds, they have an ability to take illiquid assets. Investors that do not have the ability to accept illiquidity, then by definition, an ILX strategy is very difficult. We see that in the asset management industry. You get wealth managers, large wealth managers, who would say, I would love to do this. It's fantastic. SOFR +4, my investors would love it. And how often can they get out? I said, well, you got to hang around for 15 years. 15 years. So of course it doesn't fit wealth management. I think those are the main. Obviously, the last one is emerging markets. I mean, we are taking emerging market risks, so there has to be an ability, both from a regulatory standpoint and from a risk standpoint, to understand that emerging market risk is being taken, albeit under the umbrella of the MDBs. But that's a pretty specialist risk to assess. And so That's something which ILX is having in its business model. But as an investor, the pension fund needs to have the ability to assess that risk. So that's why the individual investments are very large that we are managing. It is very much a strategy that suits the very large funds. It's a very difficult. I think it's a very complex strategy to do for the smaller funds.
Yeah, and I think, that leads to a point I was going to ask about as well, which is that one of the things we hear a lot, at least in this market and across the continent, from the asset owner side and also from the asset managers, is this idea that, it's integrating ESG and thinking about sustainability of your investments and responsible investment strategy in general is something that is a luxury for bigger managers or bigger pension funds, right? That you need some sort of specialist team to be focused on that. Can you talk to, especially around the idea of having to do the due diligence, which some would argue is just an expanded risk aperture, right? It's the same way you would assess risk usually, and others say it's a whole new level of due diligence. I know you've said, the MDBs do their own due diligence, and that gets a certain level of comfort. Are you guys having to go in and bolster that with your own? And what does the team look like?
No, so I think the essence of the strategy is to trust the work the MDBs do. And what I mean by that is not to just blindly invest in everything they do, is to trust that the data that they are receiving from the projects is good data, that the due diligence they do is good due diligence, that the ESG safeguarding that they do in relation to the standards that the company is operating in, the environmental and social action plans, the KYC knowledge they have and testing they do, that is all good information, and that is what they share in their entirety with us. So we get all the data of the investment. But it's like a classic syndicated loan, and we're not. People call us innovative, or we're the most old-fashioned game in town. We're basically investing in loans. This is what banks did 60 years ago. Many banks kind of thought they could make money elsewhere, but this is basically a very old-fashioned way of investing. And so we're relying on the arrangers, call it the multilateral development banks, to provide us with the data to make that assessment. There are moments when we do go with them on a due diligence, just because the risk is perceived to be sufficiently important, or the size of the investment. But on the whole, we trust the data they have, and they report to us the performance reporting they get from their investments, both financial and non-financial reporting they share with us. So we are basically pari passu in risk, in return, but also in data, and that enables us to make those assessments relatively straightforward. There is an issue which I think from an asset management standpoint is interesting, is we don't go through a very detailed macroeconomic assessment on whether or not it is good to invest in South Africa or in Kenya or in Vietnam. We work on the basis that of course we have our concentration limits, so we have a limit structure across country, across sector, etc. But the reason why we like the multilateral system is that that an investment with the IFC or an African Development Bank in the country to some extent mitigates some of the sovereign country risks that are there, and that we can really focus on the project risk rather than having to worry too much about the overall sovereign country risk. We have a limit that we cannot operate in countries that are CCC, but above that, we're country agnostic to a large extent within the limits framework that we have.
Yeah, I think again, it's such an interesting approach, and it's good to hear the thoughts on how investors are approaching these markets, because I will see sort of from the comments in the chats and from the general perception, there is so much potential in African markets in general, and in South Africa particularly, for financially rewarding and impactful investments, right? So there's a lot of scope for that, but what we often find is that the investment is not finding the projects, right? And I think a lot of it is things you've already spoken about. What is the sort of scope for, from your perspective, for investors to be flexible, or how do you close that gap? How do you match this kind of finance with the projects that are not necessarily big enough, or in markets that have got the right ratings? Is it a policy and regulatory issue? Is it a quality of projects issue? What do you think is the most important?
Yeah, I think that that's where there is significant that's why I think your earlier point, Nicole, on concessional finance is important. Take the energy transition, just to focus on a specific, because I know that in countries like South Africa there is a lot more needed. Of course, you need clean energy and you need efficient energy, but of course countries like South Africa need a lot more than just clean energy. But let's focus on the energy transition, just as a case in point. It's clear that there are significant elements of it that can be done commercially, and that is what we're focused on, because we are focused on the private sector. We're focused on non-concessional finance, and this is what the MDB provide. It doesn't take away that there is still a significant need for concessional finance to make a lot of these projects work. There are big parts. I mean, just take the electricity transmission network across many African countries, and South Africa is a strong case in point. Yeah, that is very difficult to do as a purely private sector project. For that, and of course, without an energy transmission system, without efficient energy storage system in a country like South Africa, it's you can do what you like with renewable energy, but it's not going to work. So there are and that is something that I what I say about concessional finance, or words like blended finance, it needs to be focused there. You don't need to have concessional finance to somehow make it easier for a pension fund in the Netherlands to invest in development finance. And a lot of the discussions about concession, about risk reduction and credit enhancement and blended finance, has been about how to make life easier for these asset managers from the global north. That's not where the problem is. They have risk capacity. They need to be brave, and some are not brave, and then they don't do it. But that's up to them to decide. But where the concessional finance is needed is to enable countries like South Africa and Kenya to absorb the ability to implement the energy transition that is needed. And a lot of it, big parts of it, can be done commercially at the energy generation point or energy consumption point. But there are big parts of it, that involve government, that involve expenditure levels that are not affordable by the country at a macroeconomic level. They need concessional finance, and that's where the 300 billion a year that was really called needs to go. It needs to go to the enabling environment for the private sector to do the next phase of the projects that need to be invested. And I think for the next phase finance, there is ample capital in my view. It's still complex. I mean, just look at life at ILX is not easy, but that layer at the bottom, in many countries is still critical. I think in that the development banks and working with local government are the conduit for that to take place.
Well, that's fantastic. I think my last question for you as we get ready to wrap up is, obviously when we looked at the registrations for this webinar, we saw a very wide range of stakeholder groups represented. So on the same list, we had some commercial banks, we had some DFI representatives, we have some asset managers. From your perspective, what is sort of, for each of these stakeholder groups, if they're looking to grow this market for financially rewarding and impactful investment, what is sort of the key thing that they need to be focusing on from their perspectives? Pension funds also on the call today. So what are some of the things, the tips you would give them, or the instruction you'd say, if there's one thing you could do, this is what you should focus on?
Well, I think one thing that I find, we are entering a new phase of finance. And over the past, just in my own career, it's just been too long. capital allocation over the coming 10 years, large capital allocation, will be done hand in hand with the public sector. And so investors, call it the private sector, needs to learn to work with the public sector. It cannot, the way finance is going to be done over the coming decade is not going to be via the Joburg Stock Exchange and via bond market, blue, red, and green. There needs to be a much closer relationship between the public sector and the financial sector. They thought over the past 5 decades they could live apart. And where they touched each other was maybe occasionally buying a South African government bond or a government bond, or buying a multilateral development bank bond. Everything through the capital market. So the touch points with the public sector was occasionally we met to buy your bond, and that was the end of it. And the rest was all via equities and bonds, and you buy an equity, you give the money to a company, and they can do with it what they like. And as long as they paid dividend and the share price went up, was fine. Or issue a bond, and as long as you paid back, it was fine. But I think we're going to live in a different world where I think that's not working. We know it's not working. I think if you're going to rely on all the companies listed on the Johannesburg Stock Exchange to help South Africa transition, my view is that it's not going to happen. They're going to play a big part. But I think there's going to be an enormous part is going to be also working with the public sector to finance the right projects. And that's the same globally. It's not a South African problem. It's the same in the Netherlands, where all the long-term projects in the Netherlands, we have a rather large climate adaptation issue to sort out in the Netherlands. That's being done by the public sector, I can assure you. I mean, there's no private company in sight who's going to pay for the climate adaptation in the Netherlands. So again, it's for the public sector to learn for the private sector to learn to work with the public sector in long-term finance, and not just by buying the bonds, by getting involved in the projects.
Oh, that's a fantastic message to end on, I think. And I think you couldn't be more right. It's really about blended finance and working together. It's the only way that we tackle systemic level problems. Manfred, thank you so much. It's been great to hear a bit more about ILX Fund and the great work that you're doing. Wishing you all the best with it, hoping to see more of it in Africa in the short term, and hoping that we will stay in touch. Thank you so much. Stuart, I don't know if you wanted to do any kind of closing or if you're happy for us to wrap.
No, just to add my thanks. It was very interesting, Manfred. I think we talk in the abstract about blended finance and the potential, and it's really good to see a real case study and succeeding in bringing some private savings into working alongside MDBs and public sector. So very interesting to see it in practice, and best of luck to you with your new fund, and we look forward to following your progress.
Well, good. Well, thank you very much for inviting me, and let's stay in touch, and we'll do it again in 12 months' time and see where it's going.
Absolutely. Thank you.
Thank you so much, everyone.
Okay.
Thank you.
Bye.
Bye-bye.